Good afternoon. This is Business Live with Ian King. The UK economy shrank by less than expected in May, figures out today reveal. Riches in re-commerce. Music Magpie reports an upturn in earnings. And we'll discuss the space technology that could help prevent pollution in British waters. Good afternoon. This is Business Live with Ian King. The UK economy shrank by less than expected in May, figures out today reveal. UK GDP was always expected to contract during the month due to the extra bank holiday for the King's coronation, but a contraction of 0.1% was better than the 0.3% that had been anticipated. Separately, the government's fiscal watchdog has warned that the UK's debt is at risk of rising to 3 times the country's GDP by the 2070s. The Office for Budget Responsibility said the 2020s were turning out to be a very risky era for the public finances, warning that as the baby boomer cohort retires and pushes up the cost of the triple lock state pension, spending is likely to be £23 billion higher in 2027-28 than at the start of the decade. OBR also warned that rising take-up of electric vehicles is expected to cost £13 billion a year in foregone fuel duty by 2030. Now, Hypgnosis Songs Funds, the UK's first quoted investment company to specialise in songs and associated intellectual property rights, said today it was working on a number of options to enhance shareholder value after coming under criticism from some shareholders. The company, which owns 146 catalogues containing the rights to more than 65,000 songs by artists including Kaiser Chiefs, Neil Young and Blondie, was reporting an operating loss of $86.6 million for the year to the end of March. That was up from one of 116.7 million during the previous 12 months. Well, joining me now is Mert Mercuriadis. He's CEO and founder of Hypgnosis Song Management and founder of Hypgnosis Songs Fund. Mert, very good to see you. Quick word on the results. I mean, how worried should shareholders be that your revenues actually fell during the year?
Our revenues fell because of one-off accruals that were made last year, but this is actually the best like-for-like results that we've ever had, with revenues up 12% if you look at like-for-like. The actual idea that we've lost money is actually not correct. That's when you amortize our catalogues over the life of their catalogues. We're making money, and our revenue, as I say, like-for-like, this is the best set of results that we've ever had. Our PFAR, which is our pro forma annual revenue, is up 12%. Our sync revenue, which is when we put the songs in movies and TV commercials and video games, is up 25%. Our streaming revenues are up 15%. So we're delighted with where we're at in terms of the actual operational performance of the company.
So the higher amortisation essentially reflects the fact that the portfolio's got a lot bigger?
Correct.
Gotcha, right.
Yeah.
So what about these calls from some of your shareholders to sell some of your catalogues and hand back the proceeds?
Well, as I mentioned in our results call today, our webinar, you know, we don't believe that the current share price reflects the quality of our assets and the value of our catalogue. So we are completely in alignment with our shareholders that that's not reflected, and we've consulted with all of them. And we're working hard with our board to put some initiatives in place that will hopefully enhance that value and narrow that discount.
I guess the problem is that the price discovery process for music catalogues is quite a complicated one, isn't it? I mean, these are illiquid assets in some cases.
You know, as you know, because you were one of the very first people to ever feature us, this is a brand new asset class. And even though it's been in the market now for 5 years, I think it's probably still the newest asset class in the market. And valuation is something that, you know, is still in its infancy in the sense of our shareholders really being educated to the extent where they fully understand what the value of these catalogues are. There's a lot of comps in the marketplace that should give confidence, but, you know, ultimately, as I say, we've consulted with all of them. We've taken on board everything that they've had to say, and we're working with the board to put some initiatives in place that would enhance that shareholder value.
So what sort of things are you thinking about?
Well, obviously, we're a public company, so I'm limited in terms of what I can say. I obviously can't say any more than that, other than, I think one of the things that has made Hypgnosis such a success with the FTSE 250 and our shareholders is that they understand that I take my responsibility to them very, very seriously. And I've heard what they've had to say, and I think that they'll be very happy with what we're sort of planning to do in the future.
I mean, obviously, when the business was created and you came up with this asset class, interest rates were near zero, and your attraction was that you offered a very steady earnings stream. Does that argument still hold now interest rates have been rising sharply?
Very much so, and as I say, that's really demonstrated by our PFAR, which is actual revenue received on statements received during the course of a 12-month period, and that revenue is up. When we look at our vintage catalogs, that's up 12%. When we look at our younger catalogs, it's up 13%. So it demonstrates that the decay that there was in the younger catalogs that we bought has really come to an end, and there's only upside in these catalogs now.
There's a vote coming up in September on whether to continue the fund. Are you at all worried about that?
Look, again, I take the responsibility to our shareholders very seriously. I think that the results today are very strong, and I think they're being welcomed as very strong by our shareholders. And, these consultations that we've had with them, I think leave them in no doubt that ultimately we are going to take on board what they've had to say and put some initiatives in place that add that shareholder value. And I think all of that together should see us pass the continuation vote, because ultimately, this is not, this is a fund that provides great income, but this is really about capital growth. And I want to see all of those shareholders that have been a part of this from the beginning see that exponential growth in the next 10 years.
All right, Mark, we've got to leave it there. Really good to see you again this morning, this afternoon.
Thank you so much, Ian.
Now, the pre-owned consumer tech retailer Magpie has blamed postal strikes and low consumer confidence after reporting a pre-tax loss of £3.1 million for the 6 months to the end of May. That was up from £1 million during the previous 12 months. But the company, which traditionally does most of its business in the second half of the financial year in the run-up to Christmas, says it's seen a much stronger performance in recent months. Well, joining me now is Steve Oliver. He's the chief executive and co-founder of Magpie. Steve, good to see you here. I mean, I guess the key point here is a lot of the loss here is accounting charges. Your actual cash position improved, I think.
Yeah, absolutely. I think, to use a football analogy, you referenced a couple of the challenges of the early part of the first half, but it has been a half of two halves. In that first half, like a lot of online retailers, were affected by the postal disruptions with Royal Mail, the early cut-off dates, and lack of consumer confidence in arrival dates. But certainly since that first couple of months, and perhaps some particularly poor consumer confidence in the early part of this year, we've really got some momentum going in the second half of our half, so Q2, and our EBITDA is up 42% year on year. So, yeah, very much a mixed performance, but we feel as though we're very much going in the right direction.
Obviously, most people first came across you when you were dealing in books and CDs and DVDs. You've migrated into consumer tech. That's now getting on for 2/3 of the business.
Yeah, absolutely. We forecast it to be 70% of the business this year. Listening to Merck talk about the newer technology in the music industry, it's been interesting for us, actually, that CD has been one of the most robust categories in our legacy category, showing there's a lot of love for the old formats yet. And indeed, we do sell some vinyl still even. But our story very much is about being the UK's biggest mobile phone recycler now, offering cash for your old phone. And as the images are showing there, with our new kiosks that are sited mainly in Asda's, providing that fast, easy, convenient, trusted service for people to get cash for their old tech, and then obviously reselling it with a 12-month warranty, our refurbished kit back to consumers.
Obviously, the speed with which mobile operators are updating their products is pretty crucial to when people get rid of their old gear. Does that worry you, the fact that Apple don't seem to be coming up with as many product upgrades, for example, as they used to?
There's a fairly regular cycle, certainly with their main product, the iPhone. So there'll be a new iPhone 15 out in, I'm sure, September, October time as normal. Perhaps people have been holding on to their devices a little bit longer with the smaller incremental gains in technology in each one. There is some rumours about some interesting new features on the new one. But actually, it's been really interesting for us because we generally operate in devices that are 2 or 3 generations behind that. So, our top selling phone is the iPhone 11 and 12 at the moment. So, and I think people, are very happy. They do now trust refurbished phones. And for the reasons you say, perhaps the gap is smaller between that and one of the new ones. So we do see a good life, good churn, people both buying and selling from us and upgrading.
Obviously, you've got a business in the US as well now. How is the US trading compared with the UK?
Yeah, good. It's obviously Decluster is our brand over there. The Americans didn't know what a Magpie was, so we had to brand ourselves Decluster over there many years ago. Very similar pattern to over here, actually. Not particularly a revenue growth story. A lot of emphasis on our gross profit, gross margins, looking at our costs very thoroughly, like any good business should, and looking to grow our profitability. So a very steady story over there. Most of our initiatives are in the UK, actually, but we do very much look to the US to take those in time.
All right, Steve, we've got to leave it there. Really good to see you again this afternoon. Thank you.
And you, Ian. Thank you.
Now, as the water industry comes under pressure to reduce sewage spills, one company is claiming to have developed an initiative designed to remotely detect sewage overspill events from space. The IT and business consulting services firm CGI, in partnership with Ordnance Survey, says its newly created artificial intelligence model can predict with high levels of accuracy the conditions most often associated with pollution events. Well, with me this afternoon to talk about this is Matty Yetter, Chief Sustainability Officer for CGI. Matty, good to see you. How does this work?
So we have developed a solution that is capturing data from Earth observations, so satellite data. That includes land management data, soil data. It includes elevation data, census data. We're basically bringing together complicated data sets, understanding the history, and developing ways in which we can predict and inform stakeholders on where pollution will likely occur.
So where you pick up on an event when the model predicts something, who do you tell? Is it the water companies? Is it the local authorities?
At the moment, it is still in the piloting phase, but the idea is that we will work with water companies, we'll work with governments, we'll work with local authorities and create some kind of a RAG alert status that will inform different stakeholders, really.
And you're testing this model in Braunton Burrows in North Devon. Why did you choose that location?
So the UNESCO Biosphere is a reserve site, as you know, and Coombe Martin, which is a village there, has previously suffered from sewage pollution and other incidents. And also working with the management team for the North Devon Biosphere, they were investigating pollution within the area. So it felt natural for us to collaborate with the North Devon Biosphere as well as Ordnance Survey, who have been researching this area previously.
And presumably you're charging for this service?
We're not charging for this service. So this service has been launched under our SEEDS program, which is a Sustainability Exploration and Environmental Data Science program, which CGI launched with the UN to conduct research and challenge the thinking around technology, innovation, and really bring together the research and academia community. And so the idea is that CGI and its partners would develop this solution, test it with wider partners, and of course share the knowledge and expertise with the United Nations and other stakeholders globally who have this challenge.
Right, so I mean, how rapidly do you think this can be rolled out outside the UK?
So we're looking at September in terms of completing the pilot for the AI. We're starting with North Devon Biosphere, of course. We've got case studies that we would like to explore in Wales and other parts of the UK. So we are looking at expanding this out to the UK between sort of September and next year, March. And then wider to the UN. Ideally, if we've got a prototype that we can share as part of COP28 this year, it would be great. But the plan is definitely for next year, March.
I mean, obviously, you're still developing this model. You're still working on this. What have you found out about it so far in the development process?
So it's been very interesting. I think the data sets themselves are very complicated. So you really are merging complex data sets from Earth observation to satellites. I think the data itself's been really interesting in terms of the patterns when you combine land management data as well as rainfall data, and you see the peaks of when actually you have the highest pollution of phosphorus or ammonia. Those tend to occur during the sort of rainfall peaks. So that really correlates with what we are seeing in terms of findings from the government and other stakeholders, that's usually when we have the largest problem.
All right, Matty, got to leave it there. Good to see you today. Thank you. Still to come here on Business Live, we'll have a look at how the markets have been finishing up this Thursday afternoon. Don't go away.
Slightly minutes, slight better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, Barratt Development says it may build at least 20% fewer homes this year as persistent inflation and a higher interest rate environment hits UK economic growth, employment, consumer confidence and spending. Well, the UK's second largest house builder by stock market valuation said it expects to complete between 13,250 to 14,250 new homes this financial year. That compares with just over 17,000 in the year to the end of June. It said the completions during the second half of the financial year just ended were down 12.8%. The shares are off around 1.5% right now. I've written about this for our digital platform, so do have a look at that if you can this afternoon. Well, the pound continues to add to its recent gains against the US dollar on the foreign exchange markets following yesterday's benign US inflation data. Sterling has this afternoon gone above $1.31 for the first time since the 14th of April last year. It's held on to that now, currently 4/5 of 1% higher so far today, also up 1/4 of 1% against the euro. Single currency, meanwhile, up by just over 1/2 of 1% against the dollar. Well, the oil price is also ticking up on the back of the weaker dollar. A barrel of Brent crude has this afternoon traded above $81 a barrel for the first time since the 26th of April. Currently, a barrel will set you back $80.29. That's up 1/4 of 1%. Well, on the equity markets, this is how stocks in Europe have finished. Generally positive tone right now. That's on hopes, of course, the Federal Reserve may soon be done with raising US interest rates. Talking points this afternoon include the Swiss watchmaker Swatch. It's up 6 3/4% in Zurich on better than expected results. Well, here in London, the FTSE 100 has also finished in positive territory. 24 points to the good there, up 1/3 of 1%. The mining heavyweights have been lending support. Barratt Developments, which I mentioned a moment ago, that's among leading FTSE fallers right now. It's clawed back some of its losses from earlier in the session. All the other FTSE house builders, Taylor Wimpey, Berkeley Homes and Persimmon, also all down in sympathy. Wall Street has continued where it left off last night. The S&P 500, the Nasdaq and the Dow have all opened higher after a rise in June. Producer price inflation this afternoon came in lower, lowest nearly in 3 years. Gainers this afternoon include PepsiCo. The shares are up by 3/4 of 1% after its quarterly results beat forecast. Well, joining me now is Haig Bathgate, he's head of investments at Atomos. Hey, good to see you. Obviously, the PPI number, producer price inflation, lower than expected. Really feels like the dollar's coming off a cliff right now.
No, it's true. We're seeing very contrasting fortunes in the US as compared to the UK at the moment, and we're seeing inflation really starting to tail off, as predicted, I think, in the US. But it's quite encouraging to see. Obviously, the US economy is the dominant global economy, so that's why we're seeing global markets rising on the back of this. Interestingly, we're really starting to see some of the second-order tech companies move in the US. If you remember, the breadth in the market's been really narrow. It's been 4 or 5 tech companies in the US driving things forward year to date. We're now starting to see the second-order tech companies come through, and they're obviously very sensitive to long-term expectations and interest rates.
Now we're into second quarter earnings season now. PepsiCo, I just mentioned them. We get some of the big US banks tomorrow afternoon.
Yeah, that's right. So we're really looking to see whether we're starting to see an increase in the default rate. We know that lots of consumers have been removing their deposits from the banks because they've not been passing on the full benefit of interest rate increases, and they've been moving into money market funds. Obviously, that's a feature which is much more dominant in the US, where investors are a bit more sophisticated, so they'll tend to try and arbitrage that. But we're really looking to see whether we're starting to see that rise in interest rates feed through to increased consumer defaults and mortgage arrears and so on.
Closer to home, we got some data from the Bank of England suggesting that mortgage defaults are at their highest level since 2009. How worried should people be about that?
Yeah, I think the UK is in a precarious position. We've discussed this a few times before. It's not the headline level of interest rate, it's the rate of change. We've seen 2-year mortgage rates in the UK almost double in the space of 3 or 4 months, and this has a latent impact. We know that the Bank of England were very slow to react to the inflationary pressures, hence why we're seeing what we're seeing at the moment. But the UK market is very sensitive to movements in the short-term interest rates, and I think it's quite complacent at the moment. I think this could be a ticking time bomb coming into the end of the year.
All right. I wish I could quiz you more on that, Haig, but we're out of time. We'll have to leave that for another day. Good to catch up with you. Thank you. That's it from me. I'm back at 11:30 tomorrow morning. Hope very much to see you then. In the meantime, thanks for joining me today, and do stay tuned, because coming up next after this short break, it's Mark Austin. See you tomorrow. Cheerio.